Major indices hit fresh records midweek and then pulled back as the Magnificent Seven crossed $20 trillion in market cap for the first time. Consumer sentiment plunged to the 58 level in September's preliminary reading, sparking fears of an economic weakness that could influence the Fed in a positive way for us. And markets price in a 96% probability of a Fed rate cut this Wednesday, but inflation's uptick to 2.9% adds complexity to Powell's balancing act. I'm your portfolio manager, Charles Brown at CB3 Financial, and the weekly podcast update starts now. Last week delivered a tale of two halves for Wall Street. The week began with renewed optimism as all three major indices achieved successive record highs on Tuesday and Thursday. Now, this is a little unusual because the Dow has lagged the S&P and the NASDAQ most of the year, but all three were in sync this week. The S&P reached 6512. The Dow crossed the symbolic 46,000 for the first time, gaining 617 points in a single session, and the tech-heavy NASDAQ also notched new highs, extending its winning streak to 5 days. However, Friday brought a reality check. Despite the NASDAQ eking out another record close, both the Dow and the S&P retreated. We're not concerned about this. We are still positioned for a strong autumn. And we are surprised, frankly, at the strength of this September. We are pleased with the strength of this September. Notably, only about 25% of the S&P 500 stocks finished Friday in positive territory. So that is a little bit of a concern. We will wait to see what happens on Monday. But for the full week, the major indices still posted solid gains. S&P up 1.6%, NASDAQ up 2%, and the Dow advanced 1.1%, posting its first weekly gain in 3 sessions. The week's rally was driven by a combination of factors, including cooler than expected producer price data. Now that's good because that means inflation is lower, and that should help us with the Feds. Also, strong earnings from Oracle that sent the stock surging 36%. Interestingly enough, if you are a CG client, we made an 8% weighting increase in Oracle and participated in that just 2 days earlier. We made that move. So full disclosure, we are in Oracle in our capital growth program. So the growing expectation of Federal Reserve cuts is what we're waiting to see this week. The standout achievement of the week, as I mentioned earlier in the opening, was the collective market capitalization of the Magnificent Seven stocks: Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla, surpassing $20 trillion for the first time, a staggering amount that exceeds the GDP of all nations on the planet except the United States. So some of the highlights: inflation and economic data. Thursday's consumer price index reading showed inflation ticking up slightly, 2.9% annualized versus 2.7% in July. Remember, we're reporting on the August inflation, not September yet, because we don't have a full month. While this raised concerns, markets interpreted the data as still supportive of Fed rate cuts given the broader economic slowdown. More troubling was Friday's University of Michigan consumer sentiment, and we watch this report every month. Why? Because it shows consumer sentiment for buying discretionary items, namely houses and automobiles, the highest priced of the consumer discretionary goods. Now that plummeted to 58 from in the 60s in July, indicating that Americans are increasingly pessimistic about their financial prospects. But we know from the past, those of you that have followed this data with me know that this is a very mercuric datum point, and that we can see this rise next month if enough things happen with the Fed, dropping of interest rates, etc. And this is not something to be concerned about long term. So the sector rotation continues. The week saw continued rotation away from the year's mega cap growth leaders towards more defensive sectors. And yet we still had a lifetime high in the NASDAQ. So we might be rotating away from mega cap NASDAQ stocks, but we still hit a lifetime high on Friday. Healthcare and utilities showed strength, while energy stocks benefited from oil price rallies following the UK sanctions on Russian crude oil. This was a positive for me. This rotation reflects growing investor caution about valuations in high-flying tech stocks, and yet I just said to you earlier, the Magnificent Seven reached a $20 trillion market cap. So these conflicting data is not something that you need to be concerned about. The market is still going up. We are still positioned for growth. And yet we still have our options hedging in place for those of you that are at Schwab. For those of you that are not yet at Schwab, your time is coming very soon. All right, so let's look ahead. As we head deeper into September, the market faces its most statistically challenging period of the year. The second half of September, historically from 1950, has been the worst performing. You can go all the way back to 1928, and the September last 2 weeks has averaged a 1.2% decline for the S&P, making it the only month with consistently negative average returns. The month has posted negative returns 55% of the time. This year could be the anomaly if we can even just finish right where we are right now. All right. So September carries the additional complexity of the Federal Reserve's critical policy decision this Wednesday. Markets have priced in a 96.4, pretty much a certainty, folks, that the quarter point cut is what's going to happen. There's only a 3.5% chance of a 50-point cut. I'm betting on the 25, as you would imagine, and I think that there will be another 25 later this autumn and perhaps a third one before the year ends. The decision comes as Fed Chairman Powell attempts to balance persistent inflation pressure against clear signs of labor market weakening and consumer sentiment weakening, which I just showed you. So the sector rotation dynamics, we want to watch this. If we continue to strongly rotate away from these high-tech sectors, maybe the market's going to come in and, this week say, well, we're going to fade. In other words, sell this new $1 trillion market cap for the Magnificent Seven. I don't bet that way, but that is what is certainly a possibility. And of course, there are also ongoing geopolitical risk, ongoing tensions with uncertainties in the Middle East, with Russia, and the Ukraine-Russia situation. It's just a mess out there. And yet the market continues to be strong based on everything I've told you and the number of lifetime highs that we have seen already in this month. So the combination of historical season weakness, elevated valuations, narrow market breadth, and policy uncertainty creates a particularly challenging next 2 weeks for us. The CB3 Live monthly show was delayed last week because of the murder of Charlie Kirk, and we are airing it this week. It will be live, and we will be handling your questions as we always do. So be prepared for heightened volatility based on everything I've shown, but also keeping a close eye on how the Fed's decision and guidance impact both bond yields and equity sector rotations. The next few weeks will be critical in determining whether 2025 can buck September's historical weakness and succumb to the pattern, or if September can charge ahead, leading the way to what is traditionally the strongest quarter of the year, the fourth quarter of October, November, and December. This is a wrap for this week. Join us Thursday night, 7 o'clock Central Time for CB3 Live's September edition. We'll see you there, and we'll see you next week for the CB3 podcast update.